Which country has got the best performing stock market this year? You might be surprised by the answer given this country's huge problem with inflation, but also its massively devalued currency this year. We begin the video by revealing this country, but also try to dig into why it's performed so well. Then we turn to my global winners portfolio, which has outperformed the S&P 500 due to its strategy of picking the best performing funds. Now you can follow this portfolio for free on stockcar.io, which is also sponsoring this video. So let's look at the country with the best performing stock market in a bit more detail. Now, if you look at the returns for 2022 year to date, you can see that this isn't really a risk on year. Equity markets have sold off hugely, so the Nasdaq is down by over 35%, and Bitcoin has more than halved. And generally, the more risky the asset, the more it's sold off. The only one of these cross-asset funds which has done pretty well is USO, which is the oil fund in the US. So if you didn't know anything else, you wouldn't expect that an emerging market country would have the best performing stock market, and yet that's the case. So here's the big reveal. You can see that the best performing stock market this year is Turkey. In fact, it's up by 24%, which roughly mirrors the 25% fall in the S&P 500. Now, if we step back further in time, in fact, if we go back to 2008, you can see the S&P's massively outperformed, even given the losses we've suffered so far this year. And over that period of time, the iShares Turkey Fund has fallen by about a half. So it's something specific about this year which has made this fund and this country outperform. Now, is that because the economy has been incredibly well managed and it's doing very well? No, it's actually the opposite. If you look at inflation in Turkey, currently it's reaching above 80% year on year. That's the official number, and unofficial estimates put it at over 100%. And if you look at inflation in the UK and the US, it's about a tenth the rate of inflation in Turkey. Now, as you can see in this Reuters story, what's odd about Turkey's monetary policy is that they keep cutting interest rates as inflation gets higher. And they've euphemistically said that that's surprised markets in this article. It's certainly unconventional monetary policy. The reason behind it is the beliefs of President Erdogan of Turkey, who despite the relentless rise in inflation insists that he wants interest rates to single digits by the end of this year. And for example, JP Morgan just doesn't buy that policy. They say that inflation will remain in the abnormally high range until policies get orthodox, and that this easing cycle will continue until it cannot. And here's the history of the central bank's policy rate. You can see that it did go up in 2019, but certainly since 2021, rates have started being cut. And central bank governors who refuse to cut the interest rates also get cut and they lose their job. So this is a nice example of why central bank independence is usually a good thing. Now, currency markets don't like unconventional policies, the UK has recently discovered. Here you can see that the Turkish lira has devalued by over 40% versus the dollar over the course of this year. So that makes it all the more surprising that TUR, which is a dollar-based ETF, has still performed so well, because you subtract 40% from the equity market performance due to the currency underperformance. If US investors could get hold of a dollar hedged version of the Turkish stock market, its performance would be spectacular. But still, even with this 40% devaluation of the currency, you can see the equity market performance has been very good. Why is that? Well, think of it from the point of view of someone in Turkey who's not able to put much into their savings account because rates are being cut in those savings accounts and inflation's at over 80%. So as this money manager from Istanbul says, there's not much option for where Turkish money can go. It's impossible for savers to ignore Turkish equities if they want to protect their savings from inflation. So everybody's been piling into the stock market and pushing up the prices. That's simply because money's got nowhere else to go. This is what StockCard looks like, and if you want to find my portfolio and follow it, just click on my name, Ramin, R-A-M-I-N, here in the search bar, choose Portfolios, and it's Ramin's Global Winners. And if you want to be notified of any changes in the portfolio, just click on this bell icon, or you can copy the portfolio. Then if there are any changes, you'll see it in this panel here. Now let's drill into the stock card for the Turkey ETF to see if we can figure out more about the fund. So you can see straight away that it's not a cheap fund. It certainly doesn't classify as having a reasonable cost. If we look at the introduction section of the stock card, you can see that the expense ratio is a very high 0.57%. Now you'd expect that to some extent for an emerging market country. They do tend to be more expensive. Now despite the fact it's had a huge rally, according to stock card it's still an undervalued fund. And if you want more detail on why that's the case, you can just click on that section. And then the valuation is split into current valuation and forecasted valuation. Let's look at the current valuation, and it breaks it down into all of the different valuation metrics for this individual fund. Another really useful box here is the exposure box, which tells you what you're buying. So firstly, you can see this is a heavily dividend-paying ETF, and it has a lot of exposure to certain sectors like basic materials, but also industrials and consumer defensive. So if we want to see that sector composition as a pie chart, we just click on exposure and expand the sector exposure panel. Now, if you look at the US, for example, a lot of it is tech, about a fifth of the S&P 500. Here, that's not the case. So the biggest sector is basic materials, and the second biggest is industrials. As a PensionCraft viewer, you get a special offer from StockCard where you get 10% off your first VIP subscription. Just don't forget to use the promo code PensionCraft, the name of our channel, with no spaces. And there'll be a link in the description which will take you to that offer. Now let's turn to the Momentum portfolio and look at the funds that we cover. We have 5 groups of funds, including 44 countries. Turkey is one of them. We have 18 factor funds, so these would be things like value or growth funds. We have 11 US sectors to choose from, 8 commodity funds, and then finally 9 bond funds. Then to build our portfolio, we choose the best performing fund in each of these 5 categories. If none of the funds has a positive return, it doesn't make it through into the portfolio. So at most we have 5 funds, or we could be completely in cash. Let's look at the return and risk of this strategy. And here you can see the return in red for the strategy versus the S&P in blue. And this goes back to 2004. And you can see that Global Winners has outperformed over that period of time. If we look at the drawdown of the strategy, that's how far it's fallen since its previous all-time high. Recently, it's outperformed the S&P 500 by choosing funds which haven't fallen as much. So the strategy is down by about 15%, a little bit less, whereas the S&P is down by about 25%. So certainly Momentum's managed to dodge some of the bullets this year. Now let's look at the performance over the previous month. And you can see it was actually pretty good compared to the S&P, which was down by about 7%. In fact, all 3 of the funds that we chose last month, so that was Turkey, DBE, the energy fund, and XLE, which is the energy sector fund, all of those had positive returns of between 2 and 3%. We can also see what actually performed best of all of the funds that we could have chosen in each category. In fact, energy wasn't the best performer, sugar performed a little bit better. Turkey was the best choice, so Momentum worked very well there. And energy was also the best sector choice. Momentum came out top there as well. And the 2 categories which had negative returns were actually excluded from the portfolio. So we didn't have a bond fund and we didn't have a factor fund. Now let's go through the choices for this month. And we start with our country choice. And you can see that the country which has outperformed by far over the 180-day look-back period is Turkey. The next best country is way behind, and it actually had a negative return over this period, and that's Brazil. And if you look at the 3 best performing and worst performing countries over that look back period, you can see that Turkey's been doing well for quite a while now. Brazil and Qatar, who are the second and third best choices, are way behind. Now let's look at our factor choice. And here, all of the factor funds are negative over this 180-day period. So we're not going to choose a factor fund at all for this month. For our sector choice, really there's just one fund which is way out in front, and that's the Energy Select Sector Fund, XLE. The next 2 you can see are defensive sectors, healthcare and utilities, and that simply reflects the amount of fear which is in the US equity market right now. Defensives would be expected to do well. And in the time series, you can see how much better XLE is than the next choice, which is XLV. That's the healthcare sector. For commodities, again, energy's come out on top. It's the PowerShares DB Energy Fund. Another fund which has a positive return over the look-back period is sugar, but that's quite a long way behind. And for our bond fund, again, all of the returns are negative, so we're not going to include a bond fund for this month. SHY, which is the very short duration treasury fund, has only lost about 5% over the look-back period, but it's going to be a long time until one of these bond funds makes it into the portfolio, I think. In summary then, our choices are the same as last month. So for country, we have Turkey. That's the iShares MSCI Turkey Fund, TUR. Amongst sectors, we have XLE, which is the Energy Select Spider Fund. And for commodities, we have DBE, which is the PowerShares DB Energy Fund. No factors and no bonds. So despite the misalignment of the macroeconomic stars for Turkey, it's actually done very well this year, and momentum tells us that it'll continue to do so, certainly over the next month. And energy's been the mainstay of the portfolio in commodities, but also for US sectors, obviously because the price of energy's remained fairly high over the course of this year. Now, don't forget our offer from stockcar.io. You can learn more about that in the description below. There'll be a link to the website. And don't forget to use PensionCraft, the name of our channel, as the promo code. And, as always, thank you for listening.